So let's think about the situation where we've got a risk-free rate of return of 0.08, and more importantly, we found that the implied volatility of a particular stock is 0.2, and the actual volatility is 0.5. So just as a quick review then as how we would calculate the implied volatility, we take the price of an option, let's say a call option, in this case a call option with an exercise price of $10 that expires in 3 days, and we'd get the price in the market, and then we'd figure out what must the volatility be to generate that particular market price. The actual volatility, we would get that by taking the standard deviation of the returns, the annualized standard deviation of the returns. And let's think of the scenario where we calculated implied volatility of 0.2 and actual volatility of 0.5. So the actual volatility is greater. So we think that the actual, or the value, using the value of this call option, using the actual volatility, we think that's greater than the value of that using the implied volatility, greater than the market price. So we want to buy them. They're selling too cheap. Of course, we don't just want to buy them because on our own without hedging, because we would take a risk. So what we want to do then, consider that our portfolio would be equal to one of those options short some stock, delta of the stock. So if the call option is selling too cheaply, then this whole portfolio is selling too cheaply. So that's what I want to buy. Now we've got two choices then. I know that the V we buy in the market, that's a function of the stock price and the time until expiry. The stock, well, it's $10 now, but of course that's going to go up, that's going to go down, that's going to change. The delta, that's the amount of stock we hedge. We have a formula for that. But that formula requires, as one of its parameter inputs, the volatility. And we've got two volatilities. We could use the implied volatility for the delta formula, or we can use the actual volatility. Which do we use? Well, let's hedge it first with using the actual volatility. So when I say here hedge with actual volatility, what I mean is using the actual volatility in the delta formula to figure out how many shares we short. Let's open up a spreadsheet then. Now, right now, we know it's 3 days until expiry, and we know the stock is selling at $10. What we don't know is these future prices where the stock is $10.50, $11, $10. We don't know the future stock prices. We'll just use these to calculate, as they come to us, we'll rebalance the portfolio. So here I opened up a spreadsheet, and what I've got here is, if I type in the volatility, the risk-free rate of return, what the stock price is, the exercise price, and how much time left till expiry, that'll output for me the D1 and D2, the delta, and the price of the call option with exercise price of $10. Well, exercise price of $10. So here I've inputted the 0.5. I've used the actual volatility. I've used time left time till expiry is 3 days, so 3 out of 252 trading days. That's the percent of a year. And I've got an output of 22 cents. So I think, using the actual volatility, that this call option is worth 22 cents. Now the market used 0.2. So the market must have been pricing this at 9.2 cents-ish. So there's a discrepancy. This option is selling for less than a dime, and I think it's worth 22 cents, so I want to buy it. Of course, I want to buy this portfolio. This part is cheap, so I want to buy the whole portfolio so I can hedge. So the stock is now $10. I'm using implied to calculate this 9 cents because this is the market price. By this V, I mean the market price of the option. But I'm going to hedge with actual. So I'm going to go and switch this out to the actual volatility of 0.5, get my 22 cents, that's what I think it's worth. The delta using the 0.5, using the actual volatility, is 0.51. So I want to short 51% of a stock, 51.78% of a stock. If I short 51% of a stock, someone's giving, the stocks are currently selling at 10 bucks, that means someone's giving me $5.17, $5.18, and I owe them 51% of a share. I'm going to take some of that cash and buy the option in the market. I'm not going to pay $22, I'm going to pay this 9 cents. So this is what the cash I have then. This cash I have is equal to, the cash I have right now is equal to the money coming in, which is the amount I short times the value of the stock. So I get this $5.18, but I'm taking some of that money, 9 cents of that money, and buying the option. So that's why my cash is equal to $5.08. Now, my portfolio, the portfolio is equal to V minus this delta times the stock. It's exactly, so it's negative, and it's exactly negative how much cash I have. So my net is 0. My net is always going to be what's my portfolio worth plus how much cash do I have. Your net always starts at 0 because you started with nothing. You shorted the stock, took some of that money, bought the option. If you were to panic and cash out right now, you could take your cash, you could sell your option, get an extra 9 cents, then you would have exactly $5.18. You could buy back your share debt, your shorted share, and you'd be done. You had nothing at the beginning, you could cash out and have nothing now. Okay. Tomorrow happens. So we're done for the day. We've set up, we've balanced our portfolio. The next day, we wake up and the stock is $10.50. So the option price has now changed. Now the option price has changed for 2 reasons. The first reason is the stock price has changed. The option is the call option is a function of what's the current stock price, and also what's the time till expiry. That's changed. Used to be 3 days, now it's 2 days. So I'm going to update. Used to be 3 days, now it's 2 days. The stock is at $10.50, but the market uses 0.2. So the market thinks that the call option is worth 50 cents. So I always use the implied volatility to calculate the price of the call option, because that's what implied volatility means. So what's the new delta then? Well, to calculate the new delta, I'm hedging with actual, so I need to go in here, input the actual volatility. Of course, the price is different, but I'm interested in this delta, 0.87. So that's the new delta. Now, how much cash do I have? Well, cash is coming from this $5.08 is what I had yesterday. I would have invested that at the risk-free rate. But also, some extra cash is going to come in from the rebalancing. So let's figure out what this rebalancing is. I'm supposed to short 87% of a share, but I've only shorted 51% of a share. So I got to short an extra 35% of a share. So if I short an extra 35% of a share and they're worth $10.50, $3.71 more cash is coming into me. So the cash I have now comes from 2 sources. The cash I had yesterday times some interest. Now the interest is 0.08, but only for a day. So this $5 and now 8.7 cents. That's the extra difference here is from the interest I made on the yesterday's cash. But also, I've got this extra $3.70 coming in from shorting more stock. So that's the rebalancing part. Now, what's my portfolio worth? Well, my portfolio is equal to the value of my option minus the delta times the value of the stock. So the portfolio is worth minus $8.64. I have this much cash. So net is equal to the sum of portfolio plus cash. My net is now 15 cents. Yesterday my net was nothing. Now my net is like almost 16 cents. So I made 16 cents. Woohoo. Okay, what do I do? Well, the next day. The next day, the stock is now at $11. Let's recalculate what the value of the option is. Two things have changed. The stock is at $11, and time is now only at 1 day left. So now the option, using implied volatility, the option is 1.003, so 1.0031741. I knew it was going to be worth more than $1 because the stock's at $11. The payoff, if we cashed the option in right now, you'd get $1. It's worth a little bit more than $1 because there's still a chance that the stock goes higher. I use the implied volatility here. Now, what's the delta? What's the delta that I should? So for the delta, I should be using, since I'm hedging with actual, I'm going to change that to actual, and the delta is equal to, well, it's even higher, 0.998863. So it used to be 0.87. So I'm going to have to rebalance again. So how much more do I have to short? Well, I'm supposed to be shorting like almost 100% of the stock. I've only shorted right now 87%. So I got to short like almost 13% more, which is going to, bring in more money. The stock's at $11. So 13% of a $11 share, that's an extra $1.40 that's coming in. So today's cash comes from two sources. Yesterday's cash, grown with the risk-free rate of return over 1 day, plus, so let's see, that's just the interest, plus I got to add to it the cash that came in from rebalancing. What's my portfolio worth? Well, the portfolio is worth, I own that option, and I've shorted this amount, this delta of an $11 stock. So my portfolio is worth, negative 9.98. But this is how much cash I have. So the net is equal to portfolio plus cash. Now I'm up to 22 cents. Nice. So let's do the last day then. On the last day, I wake up, the stock is now $10. What's my option worth? Well, I don't have to use any formulas for that. This is the last day is a special day. I just cash out. At expiry, the option's worth nothing. How much cash do I have? Well, cash comes from two sources each of those days. That's yesterday's cash grown with the risk-free rate of return. But I'm not rebalancing. because it's the last day. I'm cashing it in. So my portfolio is equal to, I own a worthless call option. I'm still shorted. I'm not changing the delta. I'm still shorted that, but now the stock is $10. So there's my portfolio. Net is still, so I'm not rebalancing on the last day. Net is still portfolio plus cash, and I made 22 cents. Okay, a couple of things. How much did I expect to make? Well, I expected to make the difference between what the option was worth, what I calculated it was worth, and what the market calculated it was worth. I expected to make 13 cents. I made more. So in theory, I should have made 13 cents. Check out that other video, the hedging with actual volatility video shows you the theory. So that doesn't jive with theory too much. But the theory assumes we hedge continuously, and I'm totally not hedging continuously. I'm only hedging once a day over 3 days. So, the volatility of 0.5, doesn't correspond with the stock prices that I actually threw down here. This is a toy example. I just put in the 10, 10.50, 11. If I actually got the volatility of the data that I used, this volatility looks way bigger than the 0.5. We could figure it out just taking the annualized standard deviation of the returns over those 4 stock prices. So that it doesn't exactly correspond with theory, I'm okay with that. What does sort of correspond with theory, if you check out that hedging with actual volatility video, you will see that that the changes in my net could be positive or could be negative. There was a positive change, there was a positive change, there was a negative change. I lost money on the last day. The theory says if you hedge with actual, that you know what you're going to get, the difference between the two values, but you don't know how you're going to get there, and there could be some days where you lose money. All right, that's hedging with actual. We could have hedged with implied. If I'm hedging with implied, what I'm doing then is the stock price is the same each day. The V is the same each day because this is just the market price of that call option. It only depends on the implied volatility and the time left till expiry and the stock price. So I can use this column in my hedging with implied section here. By hedging with implied, I'm just saying I'm using the 0.2 to calculate the delta. So let's get the first delta. The stock on the first day is $10, and there's 3 days left till expiry. So the delta, if I'm hedging with implied, the delta is 0.521753. So my portfolio is worth, I own one of those options, and I'm shorting this delta times the $10. There's where my portfolio is. The cash, well, the cash is equal to negative the portfolio because we always get our net by adding our portfolio plus our cash, and it always starts out at 0. Actually, physically, what we would have done is you would have calculated, we're supposed to short 52% of a stock. Someone will give us $5.21. We take some of that money, 9 cents, and buy the option, and the $5.12 is how much cash I would have left over. Okay, now we go to sleep and wake up. Stock is different. Value of the option is different. We'll recalculate our delta. We're using implied, so I'm not going to change that. The stock is at $10.50, and there's 2 days left. So the new delta is 0.997306. So my new portfolio, well, let's rebalance first. I'm supposed to be shorting almost a whole share. I'm only shorting a little more than half a share. I got to short like 47% more of a share. How much money is that bringing in? Well, each stock is $10.50, so that's bringing in an extra almost $5. So the cash is equal to yesterday's cash with interest plus the rebalancing cash. My portfolio is worth what the option is today minus delta times the stock. So net is going to equal to portfolio plus cash. 15 cents. So I made about the same amount. Let's do it again. Next day, going to have a new delta. The stock is now $11. The time left is 1 day. So the new delta is, stock 11. The new delta is 1. That's as high as it could be. So our rebalancing is going to be equal to, well, almost nothing, right? It's supposed to be 1, but it's like 0.997. So I should short like a tiny bit more of a share. And those shares are $11. So an extra almost 3 cents comes in. So again with the cash, yesterday's cash grow with 1 day of interest, and then I got to add to it the cash that comes in from rebalancing. What's my portfolio worth? Well, it's equal to what the option's worth, shorting this much of an $11 stock. My net is equal to my portfolio plus the cash. It went up a tiny, tiny bit. Now here's the last day. The last day I don't rebalance. The last day I know what my option's worth, it's worth nothing. So my portfolio is worth that shorting. I still have the same shorting that delta, but that debt has gone down because now it's only $10. So my portfolio is worth minus 10. My cash, I'm not rebalancing, so my cash on the last day only comes in from one source. I just grew my cash with the risk-free rate of return. And so what's my net? Okay, the theory, and to check out the theory, you got to look at the hedging with implied volatility theory video. But the theory for hedging with implied is I don't lose any money. And if you look, my net went up, up, up. Every day, the change in the net was positive. That did match theory. Here, there was some positive days, there was some negative days. Which is the right answer? Well, they're both not wrong. If you are the kind of person that will get anxiety if your net, if your net money drops one day, then you should hedge with implied because it always goes up. That's good. The bad thing is you don't know what the total is going to be. If you're the type of person who likes the certainty at the beginning, then I would hedge with actual because you know in theory what the answer is going to be. You just don't know, what sort of path your net is going to take to get there.